Hello, this is Dr. Craig Bythewood, aka Dr. B, and it gives me great pleasure to greet all of my Vietnam students in this first video. So what I'm going to do right now is I'm going to really take my time and go through all of these concepts so that you feel comfortable. I understand that many of you have not taken an undergraduate finance class before, and that's fine, because what I will do is give you the simplified version of it so that everyone will understand and you'll be able to apply these concepts in doing your assignments. So I'm going to cover four topics. First, I'm going to talk about financial statements because that is really the base of what we're doing. Then I'm going to talk about the time value of money because that's an important tool that will be used throughout this entire course. Then I will talk about bond valuation. Many of you have asked questions about that, and I will explain it. And then finally, I'm going to talk about the company selection process and the specifics and what you need to be able to do your first assignment. So let me say up front, how I'd like for you to handle this is to relax, pay attention to everything. I'll go slow, I'll repeat. And then if after I finish, you feel as though there are some topics that need further explanation, please let me know. I understand that as part of this class, I'm required to do 3 videos, but that doesn't mean I can only do 3 videos. We can do as many as we need. So we'll take our time, we'll understand this, and then what you will do is email me afterwards if you think we need to talk about some more concepts before the next video is due. So with that, let me get started. Let me also say I've really been impressed with the emails that you all have sent me. Very heartfelt, very passionate. Everyone really wants to do well, and I want you to do well. But I do want to start by talking about one of my Bythewoodisms, I believe the second one you received. Worry is interest paid on a debt you may never owe. And what I get a lot from you all is a lot of very heavy energy statements. I'm concerned, I'm worried, I don't know, it's hard, it's challenging. And I just want to say to you that when you walk in heavy energy, I can tell that you guys want to do well, so you're going to do well. The result will be the same. But think about the fact that your good grade is going to happen whether you make the journey difficult or whether you make the journey easy. So my thing is, if you ask all the appropriate questions, which you all are doing, and I give you all the appropriate answers, which I am going to do, then we can just make the process a little smoother if we do it with all the heavy language and heavy energy. So we skip past the concern and worry and difficult and hard, I don't know what we're going to do, and obstacle, and just get right to answering the questions so that we can kind of relax and make this process easier. I have been teaching for 25 years. And teaching this subject for that long of time, I realized that with this material, it's less about the material, it's less about the formula, it's less about the calculation, and it's more about our mindset. If we relax and just realize that every single thing in this class is exactly the same thing as something you do in real life, like going to the grocery store or paying a bill or getting a retirement plan, just anything that you do that involves money coming out of your pocket and doing something with it, it's the same thing as what we're doing here. So when we look at it like that, and we recognize that these are really easy concepts that have been made more challenging with the language, the terminology, we just kind of break it down to what it is, that's going to make it easier for us. So let me start off with a sports analogy. And I want you to understand that you don't even have to like sports to get my analogy, nor do you have to even know the sport that I'm going to use. And the sport that I'm going to use is basketball. Why are you using basketball, Dr. B? Well, people talk about what they know. And I have 3 daughters, and all 3 of my daughters play basketball. And I happen to be the assistant coach for their high school team, and I happen to also be the travel basketball coach for all 3 of them. 11th grade, well, my senior just graduated, starting college in August, and then I have an upcoming 10th grader, upcoming 9th grader. So I say all that to say this. Every time I go to a basketball game, there are 2 people that I always see. One is I see someone who's called a statistician. That's the person that sits at the table and they write down all the things that happen. How many points, how many fouls, how many rebounds. Again, you don't have to know what any of those things mean to know that it's that person's job to write down what happens during the game. Then another person that's at every single game is a coach. And so what happens is, at the end of that game, the coach is going to take that information and then use it to do things with. Why are you talking about this? I'm talking about this because I think it's important to separate 2 things. Number 1, accounting. Accounting is a system where someone records all the financial transactions that happen in business. And that's the same thing the statistician does. So a statistician at a basketball game is like an accountant in business. Then the coach takes that information and says, okay, let's make some decisions. Based on what I'm seeing in this book, we need to shoot these type of shots instead of these type of shots, because when we shoot this kind of shot, our percentage is much higher. So the coach used the information that they got from the documents and used it to make decisions. That's what finance is. So you need to do 2 things. Number 1, understand the difference between accounting, recording information according to a system, and finance, using that information to make decisions, because you really are doing both at the same time. You're looking at financial statements, you're looking at financial ratios, but you're also making decisions. So understanding what the statistician does in basketball and understanding what the coach does in basketball helps you to understand how you're going to do it. Now, what I just gave you is a big picture of what's going on in this class. You now need the specifics to be able to understand how to do your case studies, and I will begin to give you that right now. So, the first thing I want to talk about is financial statements. Financial statements are statements that are used to show what the company is doing, how the company has performed. A good way of looking at it, class, is this. You can look at financial statements as being a measurement of success. A measurement of success. Now, here's another sports analogy to put this in perspective. Here are 2 ways you can measure the success of your favorite team. I don't care what sport it is, whatever sport you like, whatever sport you know, whatever sport you've seen one time, you can understand these 2 ways of measuring success. The first way is by looking at the record, the wins versus losses. Now, aren't I correct that in order to look at wins and losses, you have to look at a time period? You have to look at a certain level of the season, the whole season, half the season, 3 games, 9 games, whatever it is, there has to be a time period. And the second way in which you can measure the success of your favorite sports team is the score. The score is how the team is doing right now. Aren't I correct that you can look at a score right now, then you can look away or go get something to eat and come back and the score has changed? So what I'm saying to you is the record shows you how the sports team is doing over a period of time. But the score looks at how the team is doing right now. Now, you may think that what I'm saying is very basic and elementary, but it is. And I'm doing that on purpose because it provides the infrastructure for all the specific financial stuff we're about to put on top of this concept. So all Dr. B is saying is this: when you measure success of a sports team, two ways: record over a period of time, score at a period of time. So I'm going to now make you realize that the same is true of companies. When you measure the success of a company, you can do the same thing. How did that company do over time? How is that company doing right now? So let's start with the way in which you measure how a company does over a period of time. And the way you do that is with what is called the income statement. Now, I have this up in enough time for you to write down everything. Now, I know how graduate students are. You see a diagram and you just start writing. But before we start writing, let's just talk about it. Now, you can write all this down, but it's easier to write it down one at a time as I talk about it, because I'm really going to take my time and make sure that we understand this. So, first of all, let me say this. What I have on top here is income statement. One of the things about finance is that there are so many synonyms that mean the same thing. So if you understand the logic of this, then whatever your company calls it, you'll be fine. For example, income statement is sometimes called profit and loss, or P&L. So I don't care if it's called income statement or P&L or profit and loss. Bottom line is, this is a measurement of the success of a company over a period of time, just like the record. And I'm giving you this analogy so when you look at these statements of these companies that you're going to be finding information on, it will make sense. So here's how the income statement works. The first line is revenue. Revenue or sales. Why do you have both of them up there? Because sometimes it's called revenue, sometimes it's called sales. But the way I'm going to teach you is, regardless of what it's called, you get that this first line means one thing and one thing only. It means money coming in. Money coming in. So whatever it is you do, whatever your product is, whatever you're selling, that first line on an income statement or a profit and loss or a P&L means money coming in. Now, the next line has a minus sign in front of it. And the next line, I'm calling it expenses. Some companies call it expenditures. Some companies call it cost. Some companies call it cost of goods sold. Remember, I like to take complex things and make them easy. I don't care what it said, what it's called. Regardless of what it's called, this second line always means the same thing. Money going out. This is what you receive, this is what you spend. Money going out, money coming in, money going out. Money coming in, money going out. Money coming in, money going out. So that's a simplified version of it, because regardless of what you see, it's going to be money coming in, money going out. Now, once the company records those two things, money coming in and money going out, then you're left with an acronym. So I'm literally going to write down what the acronym stands for, because that will make it a lot easier for us to understand. This is not something I want you to memorize, but I do want to have it so you can see what it means. EBIT stands for earnings before interest and taxes. Earnings before interest and taxes. So this is what EBIT means. Earnings before interest and taxes. Now, it's just an acronym. It doesn't really mean anything. You know why it doesn't mean anything? Because this is just what's left over after you look at how much you made and then subtract how much you spent. EBIT, earnings before interest and taxes. Some income statements will call this operating income. Don't memorize it. Think about it logically. Operations is what you do. It's you selling your product. It's you selling your service. Whatever you do, that's your operations. So it makes sense that if I look at how much money I make selling my product and how much money I spent to sell my product, the difference is called operating income, or EBIT, which stands for earnings before interest and taxes. Well, I like this definition better. You know why? Because it tells you what's about to happen. What is this? Earnings before what? Before interest and taxes. Now, watch this. This next line is very simple. Anytime you borrow money, you have to pay interest on what you borrow. Now, I recognize that different nations treat debt differently. But in general, when there's some type of debt, when you borrow money, you pay interest on what you borrow. Well, in the United States of America, I'm recognizing this doesn't happen in every country, but it happens in a lot of countries. Governments want you to borrow. Why? Because if you borrow, then the economy grows to a bigger extent. So what the government will do is say, hey, when you pay interest, we'll let you get a tax break on it. What do you mean tax break? Well, look, I'm subtracting interest before I pay my tax. That's why it's earnings before interest and taxes. So when you pay your interest, you're left with EBT. Now think about the logic of this. Don't memorize this, logicize this. That is a word I made up. Don't memorize it, logicize it. Think of the logic. If I have here EBIT, then I subtract out I, what am I left with? EBT, or earnings before taxes. Now we're almost finished because there's only one more thing we have to do: pay our taxes. Once we pay our taxes, then what we're left with is called net income. Net income. And that's it. We're done. We're finished. Net income. Now here's what I like about this. If you look at this, if you really look at what I'm showing you here, you're really only doing three things. You're really only doing three things. Number one, you're paying your expenses. You're buying stuff. Number two, you're paying off your interest because you borrow money. And by the way, if a company does not borrow money, guess what this number is? 0. You only pay interest on money that you borrow. So if you happen to be a company that doesn't borrow money, then that doesn't happen. Now, obviously, that won't be relevant to you because in your first case study, you have to find a company that has bonds. We'll hit that later. So back to my point, we do three things: spend money, pay interest, and third, pay your taxes. That's it. That's the whole statement. But wait a minute, Dr. B. I looked up some financial statements and it was 17 pages. True, but you still are only doing three things. What if the company has 1,420 types of expenses? That's going to make the statement long. What if the company has 47 different types of debt? That's going to make there be a whole bunch of these minus signs, but they're still all interest. What if the company is in 61 countries? There may be 61 different taxes. So just because the statement is complex and long and detailed, it doesn't mean that it goes away from this easy concept. Again, Dr. B likes to take challenging, complex things and make them easy. The income statement is simple. Money coming in, money going out, pay your interest, pay your taxes, we're done. So when you hear companies talk about the bottom line, when you hear them talking about whether they made money or lost money, they're simply looking at this. All we've done is describe how it's calculated. So it's not on you to calculate it. You're not the statistician. It's on you to understand it. You're the coach. You're the person that's doing the case study and answering the questions and analyzing how the firm is doing. So regardless of what type of income statement you see, what kind of company you use, what type of format they put their income statement or P&L in, it looks like this. So, like I said before, based on what I'm saying, if there are any follow-up questions, I want you to jot them down, and then After this is over, you send me some emails saying, you know what, I understood the income statement. Could you explain this or that, or could you answer this question about it? And I am more than happy to do a follow-up video in which I give you more details into what I said. One thing about these videos, I don't have the ability to hear what you understand and what you don't. So this is a very efficient way of doing it. Let me just jot down a question, and now let me open my mind for the next thing he says. Now, this is important. Sometimes when there's something we don't get, we get tense and we raise our shoulders up. And then that could affect your ability to be able to understand everything else I say. So we talked about the income statement. Let's just understand that, jot down our question, move on. Now, I said there were two ways in which a sports team measures itself. I said one of them was the record. The income statement is like the record, because this is how a company performs over a period of time. It's how they perform over a period of time. But the other way that you can look at an income, the other way you can look at the success of a firm, the measurement of the success of a company, is called the balance sheet. So here's how the balance sheet looks. Now, I understand that in your book, in your textbook or online, if you look up a balance sheet, it does not look like this. If you look up a balance sheet, it will look like a T account. It'll have assets on one side, and then it'll have liabilities and equity, or debt and equity, on the other side. But what I like to do, class, is I like to make it look like a pie. Why? Because it's easier to understand when it's a pie. So here's how it works. The pie represents assets. So a good way to think about this, to make sure you're with me, think about two companies you know. Think about a really strong, profitable company that you know. Now think about a small business that you know. Which one of those two companies will have a bigger pie? Obviously the first one. So that's all I want you to understand about the size of the pie. The bigger the company, the more stuff they have, the bigger the pie. And assets simply means the amount of money, I take that back, the amount of value that you have in the firm. So assets is stuff like cash, buildings, inventory, accounts receivable. What's accounts receivable? It's when you sell a product and you haven't received the money yet. So it's an account where you're going to receive it. So my goal right now is not for you to memorize all the assets. My goal is for you to understand logically what assets are. So think about it. Let's suppose you were sitting in a Columbia Southern University classroom. You could see the assets of Columbia Southern. You could see the chairs, the tables, a projector, a desk. Those are things that the company purchased, and they have those things right now. So remember, the balance sheet is like a score. It's how you're doing right now. And this first part is saying that's how much stuff the company has. This is the company's stuff. This is what they have. This is what they possess. This is what is own. This is what they own right now. Now, I want you to really hear this part. The assets, the pie. What it says is this. Write this down. The assets say, what did you do with the money? The assets say, what did you do with the money? What's the answer to that question? Well, I put some of it in cash. I bought some buildings. I bought a table. I bought a desk. I bought some chairs. I bought a copy machine. I bought some equipment. Assets. What did you do with the money? Now, if you understand that, and you do, now we look at the slices and we ask this question. Where did you get the money from? Where did you get the money from? Assets. What'd you do with the money? Slices. Where did you get the money from? And the way to look at this is very simple. If you look at this slice says debt. Another word for debt is liability. So what this slice says is this. This is the amount of the company's stuff that I borrowed to get it. I borrowed money to get that stuff. This slice says I'm using my own money. Equity is a synonym for ownership. Equity is ownership. Borrowed, own it. In fact, another way of looking at this that makes it simple, write this down in your little slices on your notes. O-O-W-E, own, O-W-N. O-O-W-E, own, O-W-N. O-own, O-own. Let me make this clear. Let's suppose you have $1 of assets. $1 of assets. And let's suppose you have a capital structure of 40-60. What does capital structure mean? Well, this stuff that you got in order to make the company is capital. The first thing you have to do when you start a company is get capital. So if I have a capital structure of 40% debt and 60% equity, that means for every dollar that I have, 40 cents came from debt, or I borrowed 40 cents. But then 60 cents was my own money. Now, I'll go a little bit deeper when we talk about the investment part of this, but I just want you to understand that these slices represent where the company gets money from, or to what proportion the company gets money. Now, it's called a balance sheet. Remember the first Bythewoodism. If you know what you're doing, you will always have a job. If you know why you're doing it, you will always be the boss. Why it's called a balance sheet is because this and this have to balance. The dollar is the same as the 40 cent plus the 60 cent. The amount of assets is the same amount as where you got the money to buy the assets. So oftentimes people look at a balance sheet as some difficult, challenging calculation, but I just made it easy. It balances because it's just two different sides of the same thing. I just came from Columbia Southern. I live in Tampa, Florida, which is about 6 hours away from Columbia Southern. And in order to travel, I had to have expenses, and those expenses will be reimbursed. Well, I have a whole bunch of receipts right over there on that table. Each one of those receipts is the same value of what I bought. So what I bought is the same value as how I got the money to pay for it. What I bought is the same value of how I got the money to pay for it. So what if one of those receipts is for this amount of money? Then 40% of it I put on a credit card. That's debt. Then the other 60% of it I use money I had in my pocket. That's my own money. So I'm just using this as an analogy to show when you start looking at these financial ratios, that's all you're doing. All you're doing with these financial ratios are taking information that comes from the income statement and the balance sheet, and you're using it to make decisions. Every one of those ratios either uses data from here, or it uses data from here, or it's a combination of the two. So think about the fact that when you look at these financial ratios and you try to use them to make decisions, all you're doing is getting data from those two financial statements, and then you're looking at them and saying, okay, what does this data mean? How do I look at this data over time and decide whether we're doing a good job? How do I look at this data compared to other companies and decide, are we doing a good job? Aren't sports teams the same? Could you not look at a sports team's record and then say, did we do better or worse than last season? Couldn't you look at your record and say how you're doing compared to the other teams? So it's literally the same thing. Financial ratios take the information that is in those statements, and then it puts them together in a mathematical relationship, looks at the answer, and then says, okay, how are we doing? Are we doing good? Are we doing bad? Are we going up in value? Are we going down in value? How are we looking compared to other companies? Are we better than other companies? Are we worse than other companies? So understanding this logic I just gave you now will make it easier when you start looking at the actual financial ratios. Okay, again, anything I said that requires more information, more clarity, more examples, write it down, email me. Now, I want to talk about the time value of money. And the easiest way for me to make you understand the time value of money is this. Time value of money represents the fact that dollars today, and obviously you can take the word dollars out and replace it with your currency. It's the same analogy. Dollars today, listen to the logic of this. This is not a calculation. This is a concept. Dollars today are worth more than dollars in the future. Dollars today are worth more than dollars in the future. Why? Because prices over time do this. They go up. Think about your favorite snack. And then think about how much that snack cost 20 years ago. If you're not sure, you don't know, look it up. Google it. Do a research on the price of this particular item 20 years ago. And you'll see that the item costs less. Prices go up over time. So dollars today will buy more stuff today than it will in the future. So that means dollars today are worth more because they can buy more stuff. Another way of looking at it is, if you have a dollar today, if you have a currency today, and you invest it in something, it can grow. It can appreciate in value. Well, dollars in the future don't have the ability to grow because you don't have them yet. So these are reasons why the time value of money is important. Because if dollars today are different than dollars in the future, which are also different than dollars in the past, time value of money is an equalizer. It is a mathematical equalizer. It allows you to be able to measure what dollars in the future are worth today. It gives you an ability to be able to look at dollars in the past and realize what they were before or what they would be worth today. Technically, I just gave you a time value of money problem because I just said, think about how much your favorite snack costs today. And then I said, go back and look at how much it costs in the past. Those are same product, but two different prices. You could also look at what that price is going to be in the future. Well, how could I do that? Well, if you look at the inflation rate and you take the inflation rate and put it on the dollar today or the dollar in the past and let it grow at that amount of time, that is going to give you what it will be worth in the future. So whether you recognize this or not, this is what time value of money gives you the ability to do. To take dollars, to take currency, and figure out what it's going to be worth in the future. Or to take currency in the future and figure out what it's worth today. To take currency now and figure out what it's worth in the future. Or to take currency in the future and figure out what it's worth today. Now, whether you recognize this or not, this dollar today and this dollar in the future, they're equivalent. I said dollars today are worth more. So since they're worth more, you'll need more of those same currencies in the future to buy the same amount of stuff that you're buying today. So look at my hands. Today, future. Past, today, future. So to understand this logic is the most important thing. Because if you understand the logic, the math is easy. All you do is take the dollars in the future and put two variables on the dollars in the future. All you do is look at dollars in the future and put two values on the dollars in the future. Number one, time. How much time between the future and today? For example, let's say it's 7 years. There's my time. I've got to evaluate that future amount by 7 years. And the second thing is interest. The percentage that represents the difference between whatever it is you're looking at. Now, we're going to get really into percentages later in the next session when we talk about cost of capital. But all you have to do to understand my point is think about this. If there's any debt that you've ever had, the interest rate that you put on it makes those dollars equivalent. So what the interest rate is, we won't get into that right now. Right now, we'll just understand that time value of money involves you taking money in the future, finding out what it's worth today. Taking money in the present, finding out what it's worth in the future. So there are four variables involved in a normal time value of money problem. First, P as in Paul, V as in Victor. P PV, or present value. Second variable, F as in Frank, V, FV, future value. Third variable, time period. And you have to recognize whether the time period is in years or months or quarters, whatever it is, you have to figure that out. And then fourth, that rate, the percentage rate or the interest rate. And this is important. The interest rate and the periods have to be equivalent. What do you mean by that, Dr. B? Well, interest rates are always quoted annually. There's an acronym that's used in a lot of commercials here in America called APR. And APR stands for annual percentage rate. So whenever you are doing the time value of money, you have to make sure that the interest rate is in the same component as the periods. For example, let's say you have an interest rate of 10%. And let's say you have 10 years. That's really easy, 10% a year. But if you have an interest rate of, let's change it to 12% to make the math easier. So if you have an interest rate of 12%, but it's monthly, now it's going to be 1% a month. Now, these are concepts. You don't have to do that calculation at all because the calculation is really simple. Now, there are a variety of ways you can do a time value of money problem. But I think the easiest way to do it is on your phone, to get an app. And this is an app that is free. And you can download it, and let me show it to you. It's called, yeah, that's not showing up very well. I'm going to email it to you, but it's called Financial Calculator. Financial Calculator. And when you click on that Financial Calculator, it gives you all of these different, this is not the right way to show this, but I'll give you the website. And again, I'm going to put this in the chat, in the class. FN, F as in Frank, N as in Nancy, calculator.com. Or you can go to the App Store on your phone and simply put in Financial Calculators with the S. This is not the only app. It just happens to be the one that your professor uses. Any time value of money or financial calculator app will make this easy. So all you do is click on the app, put in the variables I just talked about, and you can easily figure out the answers to questions. Let me give you one as an example that we can do in our head to make this make sense. Let's say you have a present value of $100. And let's say you're going to invest that $100 for 1 year. And let's assume that the interest rate associated with this investment is 10%. I've only given you 3 variables. Present value, in or number of periods, and interest rate. And your book does a really good job of explaining this. I'm just giving you the background infrastructure so when you look at the textbook, it'll make better sense. So if I take those 3 variables and put them together, $100 present value, in 1, interest rate 10, and I press the future value, bloop, it will come out and say 110. So literally it's that easy. What if I did the reverse? What if I knew the future value in a year was $110 and I knew the appropriate interest rate was 10%? And I knew that the time period was 1 year. And I wanted to know, what's that worth today? I'd simply put in my calculator, my free app on my phone, or you could do the same thing on a computer or a laptop or a desktop. I will put $110 in as my future value. Then I will put in for in 1. Then I will put in for the interest rate 10. Then I would just hit present value, bloop, and it will come out to be $100. So I'm explaining it to you like this because I want you to understand how easy this is when we take this and we integrate it into the bond problem that you're going to have to do. Now, I gave you 4 variables: present value, PV, future value, FV, number of periods, N, and interest rates, I. The only other variable that is relevant to time value of money is payment, or PMT. A payment is an amount that occurs every single period and it's the same. I'm going to assume that in your nation, you all have amortized loans, meaning you're borrowing money and you have to make a payment every month. Well, what I just described is how they calculate it. They take the amount of the loan, and that's the present value or the PV. Then they take the N, which is the number of periods or number of months you're going to be paying on the loan. Then they take the interest rate, and then they click payment, bloop, and it gives you your monthly payment. So all I'm saying to you is, A, time value of money is used to discount future cash flows to the present, or to compound dollars now to the future. 2, 5 variables involved: present value, future value, number of periods, interest rate, and payment. And depending on the situation that you're breaking down, that determines which of the variables you use to find the variable you're looking for. So if I'm you, after hearing this logic, I'm going back to the textbook, I'm looking at the time value of money chapter, and I'm making sure I understand the logic, and then I'm going to practice it with some real life situations you can make up in your head using your free app on your phone. Do you have to use a free app? No. Can you use a spreadsheet? Yes. Can you physically buy a financial calculator? Yes. But I oftentimes think that free is the best way, especially when it's effective, and it is a really good financial calculator. And hear me, there are no bad financial calculators, so any one that you can find on your app will work. And again, you can do the same thing on a desktop or the same thing on a laptop. Just go into your search engine and press financial calculator or time value of money, and you'll have plenty of opportunities to find a really easy, user-friendly calculator. Okay, now I'm ready to talk about the question that I have received the most this week, and that is bonds. I'm going to make bonds super simple to you. So I'm actually going to use this balance sheet as a mechanism to explain bonds. So I want to give you a little bit of background, and so I want you to roll with me and think about the logic of what I'm telling you. In our society, in our world, economically, companies become corporations for one main reason. Now, there has to be another main reason, because they become corporations to make money. Well, that's not really true. All companies want to make money. My point is, what makes a company become a corporation? So the answer to the question of why a corporation becomes a corporation is this: access to capital. They're able to raise large sums of money in a way that other companies aren't. Think about it. In your assignment, you have to find a company that issues bonds. And normally, only large corporations issue bonds, because issuing bonds is a way to gain large amounts of capital. So I'm going to explain to you the big picture on how firms raise capital, and there are 2 ways, but we're only going to talk about one of the ways because that happens to be bonds. We'll talk about the other one for the next video. Now, I'm going to take this balance sheet, and I'm going to use this balance sheet as a mechanism to explain the financial market or the capital market. What does that mean? When I was explaining the income statement to you, I said the company is selling a product. They're selling a service. What's the product? Clocks, furniture, blazers, microphones, desks, phones, apps. Those are the products. But there's also a product class for money. In other words, just like people buy and sell microphones, people also buy and sell money. And when they buy and sell money, it's called the financial market or the capital market. So I'm going to use this balance sheet to explain the way the capital market works. So the first thing I'm going to do is take this balance sheet, and I'm going to write at the top the word corporation. Why are you writing down the word corporation? I'm writing down the word corporation because the corporation is basically becoming a corporation. Why? Because of what I just said. They want to raise capital. The corporation wants to raise capital. The corporation wants to raise capital. The corporation wants to raise capital. Now, I'm not saying this is the balance sheet. I'm just using the balance sheet to paint this picture so you understand why the company's doing it. Now, or basically how they're doing it. Now, at the bottom, I'm going to put the word investors. Why am I going to put the word investors? Well, the reason why I'm going to put the word investors is because in order for the firm to raise capital, somebody has to give the firm the capital. Who gives the firm the capital? Investors. Investors are giving the firm capital. So up here, I've got corporations that are going to become corporations so they can raise capital. Down here, I've got investors that are going to provide capital to the companies. So you see those arrows? In between the arrows is a space. I'm going to describe a relationship between two types of investors, and then I'm going to write down the security or the financial market instrument that's going to be inside of those little arrows. So there are two ways in which corporations raise capital, and I'm going to share them both with you. So I'm going to start with this side. And I'm only going to mention this briefly because, again, we don't talk about this until later. But I'm going to mention it so we can put in perspective how it works. Corporation, raising capital. Corporation, raising capital. Investor, providing the capital, supplying the capital. Now, listen to the logic of how I describe this relationship. To make this easy, let's pretend I'm the corporation and all of you are investors. So I say this to you. This is the relationship that you and I are going to transact in. I say, listen, investors, I would like for you to become part owner of my firm. What I'm going to do is I'm going to take the ownership of my firm and I'm going to divide it into little subsections or shares of ownership. And look, didn't we say equity meant ownership? Remember we said owe and own, owe and own. Remember that? So equity means ownership. So it makes sense that I'm talking about that over on this side because I'm asking you if you would like to be a part owner of my firm. If you decide, investor, to be part owner of my firm and give me some capital, me the corporation, you the investor, if I do that, I'm going to do two things for you. Number one, I'm going to give you the opportunity to be able to sell your ownership later on. And if you sell your ownership, that means that I'm doing something good and this ownership goes up in value and you can sell it and make money. Second thing I'm going to do for you is this. Watch how these statements relate. If I make a lot of money, I'm going to take some of this money and I'm going to give it to you. Guess what that's called? A dividend. So if you become part owner of my firm, I'm going, and you in return give me some capital. I'm going to do two things for you. I'm going to give you an opportunity, possibly give you an opportunity for the price to go up. And two, I'm going to give you a cash dividend. I could do both. I could do one or the other. Now, if you haven't figured it out yet, this relationship that I'm describing, it is called a stock. A stock or a share of stock. So the equity version of the relationship between the corporation that's trying to raise capital and the investor that's giving the capital to the company is called stock. So when you hear people talking about the stock market, it's not this market. This is called the primary market. The stock market is this market between investors and other investors. Because then I just say that I might give you an opportunity to sell it. Well, when you sell it, who do you sell it to? Another investor. So I'm going to stop there because we're not going to talk about stocks for this video. We're going to do that next time. But I wanted you to understand the context. Companies become corporations so they can raise capital. Two ways they can raise capital: debt or equity. Stocks is the first way. Now, let's talk about this second way. Now, I want you to understand my logic here. I'm the corporation. You are the investor. This is the relationship that you and I are about to embark upon. I want you to loan me money. I'm the corporation. I'm the borrower. Remember, I become a corporation so I can have access to capital. You are the capital because you're going to loan me money. When you loan me money, investor, you're going to loan me money in an increment of $1,000. That's a fancy way of saying the loan that I'm going to take from you is going to be $1,000. If you loan a company of money, if you loan a company money, it's done so at $1,000 each. Now, who am I? I'm the corporation. Who are you? You're the investor. Who's the borrower? Me. Who's the lender? You. So if we look at this again, I am the person up here raising the capital. You are the person down here providing this capital right here. You're the one giving me the money. You're loaning me the money. Now watch this. If you know what you're doing, you will always have a job. If you know why you're doing it, you will always be the boss. The reason why this relationship that I'm describing, this situation where you, the investor, are borrowing money from me, the corporation, it is called a bond. I want to write that a little bit better. It is called a bond. Let me tell you why it is called a bond. The reason why it's called a bond is this. You just lent me $1,000. What if I decided not to pay you? Well, I know for a fact that in America, if you hire a lawyer, it costs a minimum of $2,500 to hire a lawyer. But I just borrowed $1,000 from you. So if I decide not to pay you and you decide you want to sue me or take legal action against me, there's really nothing you can do. I'm in control because I'm the big corporation. So governments around the world know that. So what they've done is they said anytime a company borrows money from an investor, the company is bonded by law to pay it back. That's why it's called a bond. So the first part of us understanding the logic of this is to know that a bond is nothing but a loan. It's just a loan. A bond is a loan. A bond is a loan. A bond is a loan between a company, corporation, and an investor, bond holder. So that's the first part of bonds, to understand what and why it is. Corporation borrows money, borrows it from a bondholder provides the capital. Now, here's the part you really have to focus on. This is the part that is going to allow you to be able to easily understand your case study. Here are the two things I'm going to do for you. Who am I? Corporation. Who are you? Bondholder. What am I doing? Borrowing. What are you doing? Lending. Two things that I'm going to do for you. Number one, I am going to pay you back when this transaction is over. What do you mean by that? Well, remember we talked about number of periods? Well, with bonds, there's a maturity that is decided up front. 10 years, 20 years, 30 years. Bonds are long-term loans. So that's the first thing I'm going to do for you. When that time period is up, I'm going to pay you back. Second thing I'm going to do for you, I'm going to pay you interest every period. Remember we were talking about the income statement and the companies paying interest? Well, that's where the interest comes from. I'm borrowing money from you and I'm paying you interest every single period. So I'm the corporation raising capital. You're the investor providing me the capital by lending me money. I will pay you back but I also pay you interest over time. Now, here is the part you have to walk away with. Remember when I said that this is the primary market for stocks, corporation, investor, stocks? Then I said that's not the stock market. The stock market is this relationship between investor to investor. Well, the same thing happens with bonds. This is the primary relationship, the primary market, me the corporation, you the lender. But bondholders sell their bonds all the time. All the time. Every single day, somebody's selling a bond, somebody's buying a bond. So there's a horizontal relationship between the bondholder that has the bond and some other investor that wants to invest in a bond. Here is the key. Here is the key. This is the logic you must walk away with. When you and I decide to participate in this transaction, the interest rate on the bond is fixed. It stays the same the entire life of the bond. Interest rates in the market fluctuate. They change. They shift. What makes interest rate change? The economy. You've heard of business cycles. The economy goes up and down. Economies, the Vietnam currency versus the American currency, they go back and forth in exchange rate because the economies shift and change. Same thing with interest rates. Interest rates change. That's the key right there. The key is the interest rate on the bond stays the same over the entire life of the bond. But market interest rates change. So when you're looking at some of the key factors of your case, and they're talking about how interest rates and risk and value come in, this is the way you calculate the value of a bond. Now watch this. It's easy right here. The value of the bond is just $1,000. Why is it $1,000? Because that's how much I'm borrowing and that's how much you're lending. It's $1,000. But your case asks you to find the value of the bond. Why would the value of the bond be different than $1,000? Because market interest rates change. Now I want you to roll with me here, because if you understand this piece of logic, this case will be much, much easier to do. So interest rates can only do one thing. Interest rates can only do one of two things. Interest rates are either going to go up or they're going to go down. Of course, they can stay the same. But in my analogy, I'm looking at the two changes they can make. Interest rates can go up, interest rates can go down. Now, I want you to think about it. If interest rates go up, that means that people who invest in the bond or invest in a bond can get more interest than you're making. So since they can get more interest than you're making, guess what that does to the value of your bond? Makes it go down. If interest rates go down, that means that if people were to issue bonds with other companies, they get less interest. So that simply now means your bond is worth more value. I'm going to go through that again. I just want to give you the basic premise. And think about it. Everything I'm saying right now is stated in multiple ways in your textbook. I'm just giving you the logic so you understand it. So now let's put some numbers on that so we can understand. When you and I did our transaction, I borrowed money, you lent me money. When we did that, let's say the interest rate was 10%. So let's walk through this logic. You don't have to memorize the rule. The rule is already stated in multiple ways in your textbook. We just have to understand the logic of it. So if interest rates were 10% when you and I did our transaction, that means the interest amount that you earn per year is $100. You're going to earn $100 every single year. Now, let's say interest rates go up to 15%. That means if somebody was to find a company like me and they were to loan that company $1,000, they'd get $150 a year. Why? Well, interest rates were 10% when you did your deal, but now they're 15%. So if they do a similar deal for the same amount of investment, now they're getting $150. So if you wanted to sell your bond to them, the only way you could convince them to buy your bond is if you sold it at something less than $1,000. So watch what just happened. Interest rates went up, bond value went down. It says multiple times in your textbook, there is an inverse relationship between interest rates and bond value. I'm just explaining to you why. Interest rates go up, bond value goes down, and I just explained why. Now, the other way to look at it is this. Interest rates go down. Now, interest rates, let's say they go down to 5%. That means if anybody was to issue a bond in the primary market or to lend their money to a company for the same $1,000, they get $50 a year, but you're getting $100 a year. So if somebody wanted to buy your bond, guess what? They'd have to pay more than $1,000 to buy your bond. That's paying $100 instead of $50. So what just happened? Interest rates went down, bond value went up. So what I am saying to you is, if you follow the logic of what I'm saying, I just explained to you why there's an inverse relationship between bonds and interest rates. And that's market interest rates. Because remember, the interest rate on your bond stays at 10% the entire time, in my example. So if you think about it, when do these payments and when does the payback occur? In the future. Therefore, there are discount rates, there's discounting going on or using time value of money. So technically, we've described every single component in your case. So when you talk about the company itself and you give it, first of all, net worth. Net worth is right here. There's net worth. That's how much the company has. That's how much they borrowed. But this is net worth. That's how much of the assets they own, net worth. So it doesn't say that on the balance sheet, but now you understand the logic. How's the company doing with respect to the ratios? You simply calculate these ratios. And look, the first ratio is debt to equity. There's debt to equity right there. You take that amount, divide it by that amount, there's your answer. And when you look at these ratios, you look at them over time, but you also look at them compared to other companies. Then the next thing asks you to talk about the bonds. How do the terms and collateral affect the interest rate? Well, if you think about it, interest rates are based on risk. So the less risky it is for the investor, the smaller interest they'll charge. The more risky it is for the investor, the more interest they'll charge. So all that number 3 is asking you to do is to look at the relationship between that 10% that I just gave you and what's going on. You know, why is it 10? Why is it 15? Why is it 5? So this is not a regimented step 1, step 2, step 3. It's just an opportunity for you to think about these variables and think about how they relate to each other. Then it asks you how you determine the value and the risk of a bond. Well, now that you know it's a loan, it should be easier for you to think about the different types of risks that occur with a loan. There's no difference between the risk of this and the risk of you borrowing money to buy a house or borrowing money to buy a car or borrowing money to go to school. It's the same concept. It's just broken down by this corporation that's raising capital in order to use it to do what it's doing with its firm, to purchase its assets. It's just about you lending the money to the company. And then the last thing it talks about is, how does time value of money relate? And if you think about it, it relates because these dollars are not, you know what time value of money is for? Time value of money is for the purpose of analyzing cash flows that do not all occur today. And most of the cash flows with a bond occur in the future. But how are you going to determine that price? We've already said it's an inverse relationship. Interest rates go up and bond price goes down. But how do you figure out how much it goes down? Time value of money. We've already established if interest rates go down, bond value goes up. But how do you determine how much it goes up? Time value of money. So if you think about it, you're trying to find the present value. Present value is value. It's price. It's how much the bond costs. You know how much it's going to cost. You know how much is going to be paid back in the future. Future value. You know what the payment's going to be. Interest. You know what the maturity is going to be, number of periods. So you know everything you need to know in order to find the present value. That's how you find out. And by the way, I didn't talk about the interest rate. The interest rate that goes in your time value of money calculation is the market interest rate. If you put 15 in as the I, it's going to make the value be lower. If you put 5% in as the I, it's going to make the value higher. So understanding this logic makes it much easier for you to answer these questions about how this works. So, like I said before, if there are particular items that I discussed, particular variables that you need more clarity on, questions that you would have asked me if I was sitting in front of you, put those questions in the email, send it to me, and if necessary, I will do a follow-up video to this answering those questions. So I really enjoyed the opportunity to teach you via video. I want to again remind you that our mindset is very important in how we approach this class. We just want to relax and we want to ask the questions we need to ask to get the answers, and we can just ignore all of the concepts of worry and concern and hard and difficult and challenging, and we can just do what we have to do. So again, good students like you, you'll do well regardless, but let's make the journey enjoyable by walking in a lighter energy and just asking the questions we need to ask to get the information we need. Thank you very much, and I look forward to seeing you all at the end of September, the beginning of October, and I wish you well, and I will talk to you all later. This is Dr. B signing off. Take care.